Hey, it's Michelle from Cognitive Capital. Let's talk about one of the most common mortgage questions out there. Should you take a fixed rate or should you take a variable rate? If you've been Googling and speaking with your network and you still feel confused, you're not alone. This decision is not just about chasing the lowest rate. It's about understanding how these options work, how they've performed historically, and how they align with your personal financial risk profile. In this video, I'm going to walk you through how fixed and variable rates are actually priced in Canada, what history and market data tells us about how they perform, the emotional and financial side of managing rate changes and your rate decision, the different types of variable rate products, and how penalties and flexibility differ between these two mortgage products. We're going to break it all down so that you can make a confident and informed decision. Let's start out with the mechanics. How are fixed and variable rates actually priced in Canada? Variable rates are based on your lender's prime rate, which is influenced by the Bank of Canada's overnight lending rate. When you're offered a variable rate, it's quoted to you as an equation, prime minus X, where X is your lender's discount rate. For example, if prime is 7.2 and your discount rate is 1%, you'd be paying 6.20% as a net rate today. Now, prime only moves when the Bank of Canada meets, which is 8 times per year. So while variable rates can change, they only do so at scheduled meetings. That makes them less reactive to day-to-day market news. Fixed rates, on the other hand, are priced based on the bond market, specifically the Government of Canada bond yields that match your mortgage term. If you're looking at a 5-year fixed rate, for example, lenders are going to be watching 5-year bond yields. The bond market opens and closes every single business day, exactly like the stock market. So fixed rates actually change much more frequently than variable rates do. But once you've locked in a fixed mortgage, your rate is guaranteed for the entire term. I share this because in speaking with many clients, I just noticed that most people think rates only move with the Bank of Canada, when in reality, fixed rates are changing across lenders almost every single day. For a quick performance snapshot of how these two rates have performed over time compared against each other, if I look over the last 50 years, the variable rate has actually outperformed the fixed rate 44 out of those 50 years. That's 88% of the time. And historically, when they're outperforming, they're saving borrowers on average 0.5 to 1% per year over the life of their mortgage. With that being said, fixed rates tend to win in the short term when the Bank of Canada is aggressively increasing rates, like during different periods of inflation spikes. Locking into fixed rates during these periods of time can often save people a lot of money in the short term and give them quite a bit of peace of mind. The next part of the decision is you. Your personal risk tolerance plays a huge role, both emotionally and financially, in this decision. Some people are totally comfortable with market changes and the idea that their rate may rise or fall over a period of time. But if your monthly budget is tight, even a small increase could cause you significant financial stress, even if emotionally you're okay with it. On the flip side, some clients are incredibly anxious about change, even though they have plenty of financial buffer to ride out fluctuations. So the real question is, are you both mentally and financially prepared to handle a rate that could move up or down over time? If the answer is yes, a variable rate probably makes a lot of sense for you. If the answer is no, or you're just the type of person who doesn't want to think about it, fixed rates can offer long-term peace of mind. Quickly, I want to break down when we get into variable rates. There's 2 different types of variable rate mortgages. The first is an adjustable rate mortgage. With this type of mortgage, your payment is going to change when your net rate changes or when the Bank of Canada adjusts the prime rate. When this happens, the amortization that you originally signed up for when you took out that mortgage is going to stay on track. The payment is moving to make sure that you're still going to be paying the right amount of principal and the right amount of interest that you originally contracted yourself to. The second type of variable rate mortgage is a static payment variable mortgage, often just referred to as a variable mortgage. In this type of product, your payment is actually going to stay the same, even if the interest rate is changing. So instead of the payment changing, it's the division of principal and interest within that payment that is shifting. If rates go up, more of your payment is now going towards interest than principal. If interest rates go down, more of your payment is going towards principal than interest. and your amortization is actually going to move either to lengthen or shorten during these periods of time. Each type definitely has its pros and cons. One of them offers stability in payment. The other keeps your mortgage timeline very predictable. We'll help you choose which one of these will work based on your goals and your comfort level, but it's also important to note that not every lending institution will offer both of these. Typically, banks and lenders have one variable product and it either functions one way or the other. So you may be limited if you're looking for the lowest rate, it might not necessarily exist next to the variable rate product that you're maybe a little bit more drawn to. Now, let's talk a little bit about locking in and penalties because this has a lot to do with flexibility in your mortgage. One of the major perks of a variable rate mortgage is that you can lock in a fixed rate at any time. Based on what's available from the lender in terms of their fixed rate offerings, I want to make it clear that when you lock in a variable rate, you're not simply freezing the existing rate that you have. You are saying, hey, I no longer want to be in a variable rate mortgage. I want to opt for a little bit more stability, and I would like to take whatever your fixed rate offering is on the mortgage term that I still have outstanding. Every single lender is going to have a little bit of a different rule for their lock-in periods. For example, some lenders will say you can lock in your mortgage at any time as long as you're locking into a term that is equal to or greater than your outstanding mortgage term. So if you originally took out a 5-year variable rate and you have 3 years remaining, they would not let you lock into a 1 or a 2 year, but they would give you the option to lock into a 3, 4, or 5 year. Other lenders will let you choose any fixed rate term duration when you decide to lock in. If that's something that's important to you, it's really important to pay attention to the different features and the lock-in rules on your variable rate mortgage at the time that you're taking it out. The nice thing about that is that it's really just giving you the opportunity to basically have a built-in pivot if rates start rising faster than expected or at a time that you didn't expect and you want the opportunity to lock into a fixed rate. Now, what's actually happening if you're breaking your mortgage early? Because this is a very big differentiator between fixed and variable mortgages. With variable rates, the penalty is typically just 3 months interest, simple, predictable, and the lowest cost penalty that you can typically get on a mortgage. With fixed rates, the penalty terms are typically the greater of either the 3 months interest or something called the interest rate differential penalty, which I'm going to continue to refer to as the IRD. This is a very complex equation and it's done a little bit differently from lender to lender, but it essentially compares the rate that you're currently paying with how much time is left in your mortgage versus what a lender could earn by re-lending that money today after getting it back from you earlier than they anticipated. In plain English, IRD penalties are the lender's way of essentially recovering the profit that they expected to make off your mortgage. They can be much higher than variable penalties, especially if fixed rates have dropped since you originally signed your mortgage. So, what's better? Is it the fixed rate? Is it the variable rate? The truth is, there's just really no universal answer to this. It really depends on the economy, your goals, how you personally handle risk, both emotionally and financially. Our job as mortgage brokers is really just to help you understand these options clearly. This is probably one of the areas of mortgages that I feel like most people don't understand, or most mortgage or bank professionals do not properly explain. They say simple things like a fixed rate stays the same and it's predictable, and a variable rate moves around and therefore it's risky. I think it's really important for people to define what risk means for them. If you're somebody who has a higher risk tolerance and you can handle payment fluctuation, then you might define risk as being in a fixed rate when you have information like the information that I just shared, where the variable rate is outperforming the fixed rate 88% of the time. If you're somebody who really needs to function in a space of understanding exactly what your dollars and cents are every single month, then you might define risk as fluctuation, and that's totally okay. When you're choosing your mortgage option, I think it's very important to have a detailed conversation about which of these two buckets suits you in the short term and in the long term. When you commit to a fixed or a variable rate, you're not committing for the life of your mortgage. You're committing for the term that you're contracted to with this current lender. And if you decide at your next renewal or at a future time after taking a fixed rate, for example, that you'd like to try out a variable rate option, you can totally do that. And again, as a reminder, if you do take a variable rate option, almost every single mortgage is going to have the option to lock into a fixed rate if you change your mind. Hopefully this was helpful, and feel free to shoot me a message if you have any questions.